All right, we have more changes unfolding in the U.S. economy and over at the Federal Reserve. Changes that have whiplash hitting the market and investors now holding their breath for what the Fed does next. As what just happened this past week has put portfolios on notice. Notice that no one knows anymore what to expect as the econ data is all over the place. At least the official data seems to be a bit contradictory and puts the Fed in a bit of a pickle, as there's much more happening behind the scenes right now. Pressure beginning to mount for Jerome Powell to reverse course, coming from somewhere that it shouldn't be. Well, we're going to look at what that is, what's in store now going forward, what just happened this past week and why it most likely happened. And we'll also look at what the most prescient of these Wall Street analysts are now recommending to do for the rest of 2023, as B of A's chief financial strategist laid out in detail what he says is hands down the best short-term investment, an investment that should deliver the largest returns for the first half of next year. Something you're not going to want to miss. But before we get started, press the like button and subscribe. It's all I ask for in return for making these videos. It helps me out, and I appreciate your support. So interest rates, or more specifically, the real interest rate, the rate that actually matters, now at its highest level in 16 years and continuing to move higher. And why is this so important? Well, think of it as the real rate of pain, the real cost of capital after a business attempts to pass higher costs on to their customers. Well, this rate, the real rate, which you can track actually by yourself, you can watch it in real time looking at TIPS, Treasury Inflation Protected Securities, right now sitting at 2.47%, highest level in nearly 16 years. And how this rate does its damage, the higher it goes each quarter point or each half point higher, it takes another sector of the economy with it. We can see just how fragile our system is. It took just this rate hitting 2.6%, the real rate hitting 2.6%, and the subprime bubble popped back in 2000. Took 4% before the dot-com bubble popped. Well, we're at 2.5% right now. Last month it was only at 2.2%. And you may think, well, 2.5% is not enough. It's enough. It's more than enough to wreak havoc, especially coming off of a negative real rate over the past few years. It's not just the rate that matters, but the change in rates that shocks the system. Look back to 07 or 2000. The real rate moved from 3.5% to 4%, just a half point in 3 years before popping the dot-com bubble. During the run-up to the Great Financial Crisis, real rates increased a point before popping the subprime bubble. Well, we just went from negative 1% to 2.5% in only 2 years. That's 3.5 full points. So yes, it's more than enough. We already saw it start the banking crisis, a banking crisis 6 months ago, which the Fed stymied us out of. So now it's just a waiting game to see what the next vulnerability is going to be and how much lag time exists before these rates force it to surface. And all of this riding on the Fed right now. Portfolios holding their breath, waiting to see what they're going to do next. And the waiting game has now tilted in the Fed's direction. Since the Fed's last hike on July 26, when they hiked the overnight rate by a quarter point, since then, nominal yields, real yields, and term premium all jumped virtually 100 basis points. So they raised a quarter point, everything else jumped 100 basis points. The market's finally on the higher for longer bandwagon, folks, thanks in large part to the economic data being all over the place, which is odd when you think about it. We have private payrolls from ADP last week showing terrible numbers, the lowest new jobs created in years. Then we have the government's data released on Friday showing the complete opposite. Over 336,000 new jobs, they say, were created in September. Again, it's according to the government, to the BLS, the Bureau of Labor Statistics, a number in itself misleading. I'll tell you why in a minute. First, take a listen to what the president had to say on Friday at a press conference scheduled to talk about these job numbers, scheduled, by the way, before the numbers were even released. Take a listen to this.
The highest share of working age Americans in the workforce in 20 years. And it's no accident. It's Bidenomics.
President, you started your remarks here today by saying it was good news today with the economic report. Why do you think most people still don't feel positive or feel good news about the economy?
Well, first of all, you just heard the news today, too. They haven't heard it. I think the people, those 300,000+ people who got jobs, feel better about the economy. Look, I got to choose my words here. You all are not the happiest people in the world. What you report, and I mean it sincerely. It gets you get more legs when you're reporting something that's negative. I don't mean you're picking on me, or I'm just the nature of things. You turn on the television, and there's not a whole lot about boy saves dog as he swims in the lake, to say, it's about, somebody pushed the dog in the lake. I mean, I get it, but if you just listen to what's going on around the world, there's reason for people to be concerned.
Now, the White House sees these jobs reports well in advance, and they did what any politician would do, take credit. But see, what he actually ended up taking credit for wasn't 336,000 new unemployed workers getting a new job. Instead, the unemployment rate was unchanged. It was 3.8% before the report, 3.8% after the report. The reason is because the BLS double counts multiple job holders. Huge chunk of these jobs were existing workers going out, finding a second job, which people only feel the need to do when their main job isn't passing muster or not enough to let them get by at least. Regardless, though, that report helped yields shoot even higher. As the better the economy appears to be doing, the more work it appears the Fed has to be doing. Very strange times we're living in right now. So where does that leave us then? Well, it leaves us waiting for the hard landing and or credit event to strike, because it will. At these rates, with the cost of financing being where it is, it means some type of credit event is coming. And when it does, all the sectors that are still priced for this no landing scenario are set to be unloaded. As an example, home builders still priced for the no landing scenario. Even though they've come down 10% since we first mentioned this back in July, they have yet to break, but other sectors have. Here's what Michael Arnett wrote in his Friday note. He says, 3% nominal yields in the U.S. cracked small caps, retail, and biotech. 4% yields cracked banks and REITs. 5% yields are now cracking high-yield bonds, home builders, utilities, and oil investors. Now forced to sell leverage, and deleveraging equals slower growth. Now, here's what he means. You can see it here. All sectors running up gains after 2020, but as yields continue rising, some sectors crack. REITs cracked at 4%. Home builders hadn't. REITs now price for a hard landing, but home builders still price for no landing. And like he said, there are others, folks. Big juicy disconnects exist, he says, between sectors priced for a no landing or no recession scenario, such as big tech, the Magnificent Seven, home builders, industrials, broker dealers, which is a pretty interesting one, Japan, Mexico, versus the sectors already priced for a hard landing recession scenario, such as China, banks, REITs, biotech, small caps, and in the likely event that we see a credit crunch or some type of credit event play out, those no landing sectors he expects will sell off. Again, another example, broker dealers versus banks. Broker dealers price for no landing scenario, but banks now price for a hard landing recession. But the biggest trade or investment idea from what he says is also the simplest, he says, that being U.S. Treasuries. Portfolios are waiting with bated breath to make their move, because even though a lot of people don't realize it, we are currently in the greatest Treasury bond bear market of all time, the worst peak to trough performance ever if you're long Treasuries. Take a look at this. From 2020 to today, 28 months of a real technical bear market dating all the way back more than 200 years. This table shows the largest Treasury bear markets that we've ever seen to date, and we're seeing what we're seeing right now, the one that we're currently in as we speak, is the worst by far. I'm sorting this table from worst peak to trough prices, down almost 25% peak to trough. Last time we saw anything like this was over 160 years ago, during 1860 to 1861. That was only down 18.5%, but here's the good news, folks. Take a look at the one-year recovery from the trough in every other bear market. Obviously, huge upside always follows the trough, and at the moment, the recovery is yet to begin. but it will. And when it does, it will likely be huge. In fact, according to Hartnett, he says treasuries will be the best investment return for the first half of 2024. And you can see on this chart just how cheap the 10-year treasury is right now. This is the price for the 10-year as we speak. Year to date down 10%. The trough for this bear market, by the way, was hit last year in October. But the recovery hasn't technically started. We're still in the bear market. The last few weeks, for example, have been brutal. So going long treasuries as it gets cheaper over the coming weeks and holding it into 2024 is the trade, from what he says. As simple a trade as it gets, and being U.S. treasuries inherently safe if you have to hold it, Hartnett writes this: once recessionary bond and stock markets mutate into the economic data, bonds rally big, and bonds should be the best performing asset class for the first half of next year and throughout the first half of 2024. Now, again, this all depends on the Fed and how much you buy into the higher for longer narrative, because as much as they say that, remember what happened 4 to 5 years ago. The Fed began to raise rates and Trump wouldn't have it. He put pressure, a lot of pressure, on Jerome Powell, who capitulated, caved into Trump, and started to cut. So it could happen, and we are 1 year out from what the current administration believes to be the most important election ever, something that we always hear politicians say, but you best believe that there are some people in this administration, ideologically speaking, who most definitely believe that believe that Trump is an existential threat and cannot win no matter what. So putting pressure on the Fed to reverse course and start pumping out the stimulus again during the run-up to the next election is not only likely, but probably already happening. Hartnett writes this: nagging fear remains political. In 2024, 80% of global equity market cap, 60% of global GDP, 40% of world population heads to the polls, an incentive for more, not less, fiscal stimulus. Ultimate fear is loss of political and policy credibility, which engenders bond yields up, US dollar down, crash trade, November 17th, new government shutdown deadline. Now, he also says that he's convinced this bear market has unfinished business, he says. So again, all of this is unfolding right now. The largest treasury bear market ever, bond market whiplash, yields spiking, mortgage rates now in spitting distance from 8%. Volatility that we've been speaking about come the end of 2023 is here. It's unfolding right now, and we have less than 40 days before the debt ceiling is hit. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.